meeting is being recorded.
Okay, let's start. Thank you for joining us. We are going to spend our time together talking a little bit about the foreclosure prevention in regards to COVID-19. Question, what happens if you can't pay for your mortgage? So that's the emphasis of our time. And let's go to the next slide for the agenda and sort of let you know what we're going to use our time with. So we're going to check in just a bit. And after we check in, I'm going to go over some basic Zoom logistics, then go over our session objectives. We're going to do a quick 3-question participant poll, just to kind of get a sense, you know, what's happening on the ground in terms of foreclosure and how that may be affecting some of our entities here and the community. And then sort of the meat and potatoes of our session and looking at and understanding and having conversation on forbearance basics. And we have resources that we want to offer and share and talk about. And we'll be wrapping up with having you all be aware of what's in the horizon and wrap up. So that's what we have to share with you all this morning. So let's see how you all are doing this morning. Those of you that can see the screen, I would love for you to use the chat here and tell everybody how your week is starting off. Do you feel like raccoon number 1? Do you feel like raccoon number 2, raccoon number 3, and raccoon number 4? So please put that in the chat box. We want to know how you're feeling this morning or how your week actually is starting. And those of you that are on the phone, because you can't see the pictures, although hopefully you have the PowerPoints, you'll know. If you can tell us, the folks that are calling in, let us know who is calling in. Just unmute yourself and let us know your name. And hopefully you have the PowerPoint in front of you so then you can tell us what number you are.
Yeah, Vicki, they don't have the PowerPoint. We're going to send out all the PowerPoint and slides after the webinar along with the recording. Okay.
Well, it'd be great to at least know who's on the call, who called in. Oh, we got some 3s.
Hey, Vicki, this is Mark Lossing with South Dakota Housing.
Hi, Mark. Thank you for joining us. Good morning.
Yep, glad to be here. Morning.
Wonderful.
I'm a 3, I'm a 2 too.
Okay, good. Anyone else that's on the phone?
Yes, my name is Nicole Hahn and I'm with South Dakota Housing.
Wonderful. Thank you, Nicole. Anyone else that's on the phone?
Hi, Vicki. It's Mary with South Dakota Housing.
Hi, Mary. Good morning. Thank you for letting us know that you're here. Who else is on the line?
Good morning. This is Anna. I was able to see the raccoons, and I think I'm number 1.
It looks like majority of the folks that have responded, it's maybe a 2. There's some, I think 2's winning. It's interesting. Okay.
Is that because they're lounging, Vicki, or is that a lounging raccoon, or is that a raccoon who's giving up?
Well, our business partner here, Leslie, is a 4. She's playing peekaboo. I don't know. It's everyone's own interpretation. You know, I just wanted to see how folks are. I'm curious about the number 3s. We have a couple of number 3s.
Good morning, Vicki. This is Brent from South Dakota Housing. I think I'm a 2, but my staff thinks I'm a 3.
Thank you, Brent. Thank you for sharing.
Even when you're working virtually, Brent?
This is Mary, and I can't see the pictures, so I really wish I could. I could tell what Brent was.
Thank you so much, everyone. I just wanted to bring in some laughter, you know, and just have us check in and just make light of where we're at. So thank you so much for those of you that participated, and any last calls, call-ins from folks that are on the phone. Okay, thank you so much. All right, so mute yourself if you are on the phone or even on Zoom. Background noise, it's hard to hear, so just be mindful of that. Thank you for using the chat box. We encourage you to use that throughout our session today. for questions, maybe emphasizing something that's being said, underscoring that, highlighting that, or adding to whatever we're mentioning today, please use the chat box. Raise your hand. If you're on the camera, you can also raise your hand, and Leslie will be helping to monitor the chat box as well as the screens. Joanna will be also moving the slides, but also helping with the delivery of the content. You can also see at the bottom of your screen, blah, 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 the reactions. So you can get a thumbs up if you're in agreement. Yay, good point. So feel free to use those other elements on here as well. And phone users, we encourage you to you know, be as participatory in this process. I know some of you can't see the screen, or so just listen, and I just ask everyone really to be present. It's hard to do that with all the distractions, especially with the virtual pieces, but to also just unmute and then chime in when you best can. And a reminder that this session is being recorded. So we will send this out to folks who are not able to participate or be a part of our session. Okay, thank you. Let's go to the next slide. So when we had our check-in a couple weeks ago, we've been hearing from you all and hearing from practitioners about what and how do we want to be using our time together. And so part of that is being reactive in a very kind of positive way, and how do we prevent, and how do we save, and how do we be mindful about sort of the assets that our community members are, you know, have worked so hard towards in terms of homeownership. And so because of this particular pandemic, we thought this would be a great topic. And so in our session today, our 3 objectives that we want to cover is really looking at how do we empower practitioners to support their clients that are being impacted by this COVID-19 virus. Also to look and be aware about key players in this space, and also the being more familiar with the loss mitigation terms. We hear terms all the time, and it's, you know, we just want to make sure that everyone has sort of the clear understanding and foundational basics of these terms, so we know what we're talking about, and we're able to better advocate for clients, and helping clients also to advocate for themselves. And then really to support each other and to really protect homeownership assets. So that's really the big overarching objectives for this particular session. So what we're going to do now is we want to get a sense, if we can move to the next slide, we want to get a sense of, we have 3 questions that we're sort of asking, and Joanna's going to start the poll. So we just ask that you, when you get the notice to answer the polls, we're going to do 3 of them. So here they are. The first one is thinking about the clients you have supported through home buyer education, loan packaging, or direct lending. How many mortgage borrowers have contacted you seeking mortgage relief? So is that 1 client, 2 clients, 3, 4, or 5 or more? So if you can respond to that. The second question is thinking about the clients you have supported through home buyer education, loan packaging, or direct lending. What percentage of your clients do you anticipate having problems paying their mortgage over the next 3 months? So if you have a portfolio of, you know, 12, you know, what's, you know, is that 25, what's 25% of 12? You know, 50% of 12, is that 6 of them, or is that all of them? So we're just wanting to get a sense of what percentage you think you'll have problems with based on your portfolio. And the third question is, how likely are your clients to make a call to their serving agents to explore mortgage relief options? So how likely are your clients, you know, do you feel that could do that on their own? So if you can respond to that, and then Joanna's going to share the results shortly, and we'll see what's happening.
So just to clarify, question number 1 is as of today, like how many people you've heard from as of today. And think broadly, guys, about who you serve. We know that there's some native CDFIs and lenders on the line. and so obviously you will have gotten people calling you directly about their loan, but think broadly, like many of you are helping to prepare home buyers. So even if you're not the lender and you had some role in getting them into their mortgage loan, either through home buyer education or through loan packaging, you know, how many of your those clients have you heard from? That's number one, as of today. And number two is, over the next 3 months, how much, what do you project? Like, what do you think is going to happen based on what you know about your clients? And I have to apologize because I forgot to go back and change the typo in number 3. It should say loan servicing agent. So there's a typo there, just so that you're not confused. It's the servicing agent. How likely are your clients to make the call to the servicing agent to explore mortgage relief options? And that's the point to this whole webinar today, is to talk about making those calls. So I'm going to give you guys a few more time. I know that if you're only on the phone, you can't do the poll, but I know we have more people that are on the video than are on the phone. So I'll give you just a couple more minutes and you don't have to answer all 3. You can just answer as many as you know the answer to, but I'd love for you to go ahead and take a guess. Okay, looks like everyone that's going to vote has voted, Vicki, so let me share the results.
Well, let's see. So for question number 1, we had 56%, at least one client, more than half. And then the other one is 5 or more. So that's at 33%. The second question about the percentage, a good chunk in the next 3 months feel like less than 25%, and then 25%. And then the third one here, clients calling on their own behalf, very likely, and then probably with some coaching. So a big chunk of folks are saying with some coaching. So thank you so much for that. It's just helpful for us, but I think it's also helpful and revealing to you all as practitioners to think about like how to anticipate the future. What do I need? How does our organization need to shift, and how we do our approach with clients? You know, in this case, like the third one, like we may have to do more coaching. And what does that look like? How does that script look like? You know, maybe it's a script and how we have to prepare for a client. But also kind of looking down the horizon and, you know, preparing for the upcoming months. What does that look like? And what sort of things need to happen? Other thoughts about this, Joanna?
I just had one question about the folks that responded that have had 5 or more people call them. If anyone wants to share, if you're in that category someone who's had 5 or more clients call you so far, anyone want to share who they work for or anything about that answer?
This is Laurie Gross, South Dakota. So our portfolio is fairly large, and I would say, you know, we have 6 as of today. So,
and Laurie, those are your mortgage clients, right?
Correct.
Okay. Yeah. So I kind of assumed that the folks that had 5 or more had larger loan volume. Anyone else want to share? Okay. And as Vicki said, it looks like most people are anticipating less than a quarter of their portfolio will have problems over the next 3 months. So that's good news. But we'll have to see how that pans out. Okay, so any other questions? I'll turn it back to Vicki. Any other questions on the poll results, or any other comments, I should say?
I think Elaine might have had a comment.
Elaine?
Maybe not.
Okay.
I just wanted to, I guess, I don't know if it's a comment. It's Anna, but we're not a CDFI or a lender or a bank or anything, but we haven't had like anyone call us at all for any of the things for any mortgage relief or like that. But we work a lot with trying to be engaged in the community still through social media platforms. So like if there's anything that you guys are doing that we could help share information and resources or whatever you guys have, we could definitely use that on our social media platforms.
Thank you, Anna. I also think, as I'm just, thank you everyone for sort of chiming in, letting us know like the response, but also sort of the size of the portfolio. I think it's an opportunity here to have folks be thinking about how can we be proactive, even though the percentage is low, what would that look like? And how do we shift sort of some of these service pieces so that we're ahead of the game, versus waiting until the clients come in. It may be like we be more proactive by reaching out to clients, checking in with them and see where they're at and what can they do, reassess the budget, so the numbers can stay low in terms of not having problems. And I think it's an opportunity for you, for organizations to be thinking about how to enhance services in the future if something like this another sort of crisis were to come to prevent foreclosure. So just something to think about in terms of products and services and being more preventive, proactive, and then also customizing and then sort of following up with clients on what this, what you all can do or how they can move in this time. Anna?
Awesome.
Just one more comment, but that's kind of like what we did. We have the homeowners here at Thunder Valley that we reached out just to check in with them and like see if there was anything that we can do as practitioners or for a financial or home buyer, TA, whatever. But we also made calls to like local banks, like the that do consumer loans, that are doing car loans, Lakota funds, just to see what they were doing for clients. And we were trying to use that way to get, information to put out on our social media. So if you guys do have information or want to share so we could pass along to home buyers, like Star had mentioned, like some people don't know what to say or ask, so that's why they're not seeking out.
Great, thank you, Anna. And if folks have questions on how you all are doing that, we can have them call you. Okay, so the meat and potatoes of our session, the topics that we're going to be talking about, Joanna is going to be emphasizing, and of course, we have many folks on the call. We encourage you, if you know and have things to offer on these topics, that we welcome you to chime in. So we're going to look at sort of the basics here. We're going to look at lender versus loan servicer, the difference between the two and their roles, as well as looking at delinquency, default, and foreclosure, making sure we understand these terms. As I had mentioned earlier, we tend to use these terms, but we want to make sure that we're really clear on what they mean. Looking at the coronavirus mortgage relief options, and then resources. So Joanna's going to walk us through these next couple of slides. Joanna?
Great. Okay. Thank you, Vicki. Let's just go ahead and jump into it, guys. And I know we have a lot of experts in the field who are on the call with us today. So I completely invite any comments or additional reflections on any of these topics. So, I mean, that's the beauty of a coalition, is that we all work together and we all collaborate. So we appreciate everyone who's on the line and encourage you to either add thoughts in the chat or take yourself off mute and kind of interject as well. So, so we thought we would start just kind of with who are the players. And a lot of times folks get, sometimes can be confusing when it comes to situations like this, when we spend so much time working with lenders to get people into mortgages, to have them become homeowners, and the relationship they've established is with the lender. And the lender is the entity that actually makes the mortgage loan to the borrower. And they're the entity that has done the underwriting. where they've actually looked at the borrower to assess their capacity and willingness to repay the loan. So that's all the stuff that happens on the front end of the loan. Now the loan servicer is a different, it can be a different entity depending on the type of loans, and we'll go through that in a minute. But the loan servicer, think of the loan servicer as kind of, they're more of kind of the special assistant to the lender. Like they're I don't want to call them administrative assistant, but they're the assistant to the lender who manages kind of the day-to-day operations of the loan after it's in place. So they collect and transfer mortgage payments. They collect the monthly payments. That's who the borrower pays. They manage the escrow account. So if you remember back to our homebuyer education days, and as you're working with your clients, the PITI, the principal interest, taxes and insurance. Now, not all, as we know, not all mortgages in Indian country are subject to tax, but where there are applicable taxes, it's up to the loan servicer to pay those taxes and to manage that escrow account for both taxes and insurance. And they also provide, and this is the third bullet that you see on the screen, is mortgage assistance through loss mitigation. That's the topic of this call. So this is where when things get to be difficult for the borrower, it's the loan servicer who comes in to save the day to help to provide that mortgage assistance to the borrower. And that's the topic of this call. And then the fourth bullet, which is administering foreclosures, that's actually what we're trying to avoid, obviously. But that's the role that the loan servicer plays. They actually administer the foreclosures. So, and when you look at what the lender and the loan servicers do, I'll go ahead and move to the next slide. And you'll see that in some cases, the loan servicer is the lender. And in some cases, a lender may decide that they want to service their own loans. And where we see that the most are with the native CDFIs, and any CDFI for that matter. Not every native CDFI services their own loan. Some don't, but all those in South Dakota do. So where Forbearance and Maziska, you guys service your own loans, right? Like you continue that contact with your borrowers. Colleen and I don't know if you guys are on mute or not, but
yes, we do,
yep.
Joanna.
Okay, great. So Maziska services their own loan. Forbearance, I don't know, do we have anyone from Forbearance on the line today?
Not yet. They have some other stuff happening today.
Okay. All right. So,
but we have other Cheyenne River partners on.
Okay, perfect. So, and someone needs to change the battery in their smoke alarm. I can hear.
Joanna, I also just wanted to mention that Mark has just shared a resource that it looks like a blog about reaching out to loan servicers. So we can certainly share that after the call. But I just wanted to point that out. And when it makes sense, Joanna, maybe if Mark could let us know what he shared.
Sure, we can do that now. Mark, what? It looks like you guys just put out a press release.
Yes, Joanna, this is Mark. We put out a press release yesterday for homeowners, struggling homeowners, as to what to do, and basically contact your servicer. There are forbearance provisions out there for federally insured loans for up to 6 months, and I think they can increase that or add another additional 6 months onto that. And we're doing that same forbearance for all of the whole loans that we have, whether they're uninsured, privately insured, or whatever type of loan it is. But it's just letting the public know that if you're struggling as a homeowner because of the COVID-19 virus, contact your servicer and they'll have information as to how they can help you.
Perfect. Thank you so much. We'll definitely add that to our list of resources to share with everybody. We'll email the link out to the coalition membership, because at this point, you know, there are a lot of great national resources which we've shared, but it's also very nice to have more local information from South Dakota. So thanks, Mark, for sharing that. And I mean, and I think some folks may not know that South Dakota Housing Development Authority actually is a housing lender as well. And I don't know if you guys would fall under, where you guys would fall under on this chart. If you would be your own chart, Mark, where would you put yourself? Are you in the like Fannie Freddie conventional loan category, or it could be all of the above, right? FHA.
Right, all the above.
Okay.
FHA, rural development, VA.
Perfect. Okay. So in looking at this, that's part of what makes this work so tricky, because every different types of loans and different private lenders have different loan servicers, and then the options that are available to your borrowers depend on what type of loan it is. So you could have one house next to the other and they might have different options for them under forbearance. But that's where you guys come in to help those borrowers navigate through this process. So if you're a native, just to close out the discussion about this chart, if you're a native CDFI in South, if your borrower has borrowed from a native CDFI, then the native CDFI is their loan servicer. If it's a HUD Section 184 loan, it will depend on the lender. So, so it just depends on who the lender is as to who the servicer is. So like, I don't know, is Jewel on the line? I didn't see Jewel on the line, but my understanding is that First Tribal Lending just recently started doing all of their servicing in-house. So when you call, your loan servicer for a Section 184 loan through First Tribal Lending, you'd be talking with someone at First Tribal Lending. When you call for another lender, it might, of 184, it might be to another servicing agent. And then for your borrowers who have 502 direct loans, not our 502 relending loans that are through the native CDFIs, but the 502 direct loans from USDA. And I saw Ted was on the line, and I don't know if anyone else from USDA is on the line, but they have their own internal servicing agent. And I put in St. Louis because when you talk to the RD folks, they always talk about, oh, well, you got to call St. Louis. And maybe that's because it's got a big, long, fancy name, but it's the National Financial and Accounting Operations Center in St. Louis. So they do all the servicing for 502. And then the VA for veterans, VA Native American Direct Loan program, that, like the 502 Direct, is an internal direct loan that's made by the government. Rather than having an internal loan servicer, they have a vendor that they contract with. And in this case, the current vendor that does the loan servicing is BSI Financial Services. It used to be DITEC, but now it's BSI Financial Services. And
Joanna?
Yep.
Joanna, this is Brent from South Dakota Housing. I think that's a great chart. I just wanted to let the audience know too, is a lot of times we get calls from consumers that maybe originated a loan at one lender, but it was sold to another lender and then consequently serviced by someone else. So it's not a direct line between lender and loan servicer necessarily every time. It might go from lender to lender to lender and then loan servicer.
Absolutely. Thank you for sharing that, Brent. And that's another reason why sometimes it gets confusing, right? Like, and we've seen that a lot of the TVSOs, for example, the Tribal Veteran Service Officers, are frustrated because their veterans, it wasn't the loan that was sold, it was the servicing agent contract changed, and so it was transferred. But in some cases, the loan is sold, and depending on who the loan is sold to, they might have a different servicing agent. So it might change. And one tip, and I don't know, Brent, if you have other suggestions, but one tip that people are saying is to figure out who your client servicing agent is to look at your monthly mortgage statement. Go to the statement that you either get in the mail or you get online, depending on whether your client does online banking. Most will probably get a mortgage and monthly mortgage bill. If you look at that mortgage bill, it should give you information about who to contact, and that's the servicing agent. And another clue is who you mail your mortgage payment to. You know, my husband and I have a VA loan, and we don't mail the mortgage payment to the entity who made the loan to us. We mail it to US Bank because that's who services that loan. And that's who you know, is our relationship. And if we ever had a problem, we'd call US Bank because that's who we get our monthly mortgage bills from.
That's right, and that's typically what we do is we say, where do you make your payments, or who do you make your payments to, and that would, that's who you need to be contacting if you have any questions on your loan, not the original lender. That's right.
Absolutely, yeah. And so that might be the first question that you guys as native homeownership practitioners would ask your client is, who do you pay on a monthly basis? Who do you make that? Let's look at your mortgage statement and figure out who you should be talking to. And the last one that's on the slide, for those that can't see, are the conventional loans, like Fannie or Freddie loans, which, as you guys know, is not currently available on trust land, but is available to Native people throughout the state. And Fannie and Freddie would like to have their conventional loans available on reservation. So that is something down the road. But when it comes to who services those loans, again, it depends on the lender. And as Brent said, you would have to look at figure out who you pay. So I just wanted to spend a few minutes distinguishing between the lender and the loan servicer, because that's a really key distinction when we're looking at how best to help clients. Okay, any other questions about that? Any other comments, questions before we move on to the next topic? Okay, Leslie, let me know if you see any hands raised or any chats or anything.
Nope.
Okay, all right, well, let's move on. On this slide, we define delinquency, default, and foreclosure. And part of the reason why we wanted to just go back to the basics here, I mean, this is something that you would have covered in your basic homebuyer education class. But what's the important point here, and this is a major theme that I want to make sure everyone has in their heads as they're going through, is that you want to avoid, obviously you want to avoid being officially delinquent, default, or be moved towards foreclosure. Being delinquent means that basically you're late. Your payments are late, they're past due. Usually it's more than 30 days. Sometimes people consider a delinquency, at day one. It depends on the lender. The closer the lender is to the community, like CDFIs, they are, very tend to be have more early intervention, and early intervention is a good thing, as you guys know, because as things become more late, then it's harder to get back on track. But the reason why it's so important for your borrowers to call their servicing agent is that you want to avoid being delinquent or going into default, and by initiating the forbearance period, by making giving notice that that you're late because of COVID-19, or quite honestly any kind of financial situation, that is going to keep you from going down this path. So the path of delinquency is being late. The path of default is where, because you're late, you have violated the terms of your loan agreement and you are technically in default, considered in default. And then that's what could initiate your foreclosure process. And that's where it's a legal process and you go to court, and of course we want to avoid that. We're not going to get into the details of foreclosure now, but I wanted to this is what we want to avoid. These steps, going down this path is not where your home buyers want to go. So let me just move on to the CARES Act mortgage forbearance. So we went back and forth about what to share with you guys, but we have found that this video is very general, but it is very straightforward and really helps to provide an overview of, and I'm going to stop my screen. And Vicki is going to share the video with you guys. And why don't we just go, before she starts it, I just want to say that we're going to share this link with you guys as well. And then after we watch the video, it's only three and a half minutes long. We'll kind of unpack what this gentleman is talking about. So let me go ahead and Vicki, and if you could start the video, and hopefully our audio will work well. We're not hearing it, Vicki.
Emergency. Forbearance.
There we go.
Sorry, because I was on mute. I didn't want to hear me, but.
Okay.
Okay, here we go.
Difficulty making on-time mortgage payments due to the national coronavirus emergency. Forbearance may be an option for you. Forbearance can help consumers get back on their feet during short-term financial difficulty. But there are a few things you need to know and some important decisions you'll need to make. Forbearance is when your mortgage servicer, that's the company that sends your mortgage statement and manages your loan, or lender, allows you to pause or reduce your payments for a limited period of time. Forbearance does not erase what you owe. You will have to repay any missed or reduced payments in the future. So if you are able to keep up with your payments, keep making them. The types of forbearance available vary by loan type. If your mortgage is backed by the federal government, this includes FHA, VA, USDA, Fannie Mae, and Freddie Mac loans. Provisions of the recently enacted CARES Act allow you to temporarily suspend payments if you are experiencing financial difficulty due to the impact of the coronavirus on your finances. Loan servicers may also have forbearance or deferment options for non-government backed or private loans, but the exact options available to you may differ. Here's how this works for federally backed mortgages under the CARES Act. If you are experiencing financial hardship due to the coronavirus pandemic, you have a right to request forbearance for up to 180 days. You also have the right to request an extension for up to an additional 180 days. But you must contact your loan servicer to request this forbearance. There won't be any additional fees, penalties, or interest added to your account, but your regular interest will still accrue. Other than telling your servicer that you have a pandemic-related financial hardship, you won't need to submit additional documentation to qualify for this forbearance. It's important to find out what options are available to you. The best place to find that information is from your loan servicer. Look for their contact info on your monthly mortgage statement. Right now, most financial institutions, including mortgage servicers, are experiencing high call volumes, so there may be long wait times to talk to someone on the phone. Regardless of the type of mortgage you have or how you communicate with your servicer, here are some things to consider. If you cannot make your mortgage payments and you are looking to suspend or reduce your payments, you will need to work with your servicer. If you decide to move forward with a forbearance plan, ask your servicer how you will be required to pay back the amount owed after the forbearance period. Will you owe the entire unpaid amount in a lump sum once the pause period has ended or at the end of the loan term? Can the loan term be extended so that missed payments are added to the end of your mortgage? Will your subsequent monthly payments be higher for a period of time to make up the deferred amount? Finally, be on the lookout for scams and scammers looking to take advantage of consumers affected by coronavirus. You might receive fraudulent calls, emails, text messages, or other offers to help you reduce or stop your mortgage payments. Make sure you are working directly with your mortgage servicer. For more in-depth information, including information on how to find a HUD-approved housing counselor, go to consumerfinance.gov/coronavirus.
Okay. Thank you so much, Vicki, for sharing. I'm going to go back to our PowerPoint here. Peggy had asked, could we share the link to the video? And we definitely, we will, there's a link to the video in the slides. So you guys will get that. And you also can go to the consumerfinance.gov website /coronavirus, and you can see a bunch of really great helpful tools when it comes to how the CARES Act affects mortgage forbearance. And one other thing that before we move on to our next couple of slides, thank you to Laurie, who also mentioned that sometimes your borrowers may have a hard time figuring out who their loan servicer is if they pay by ACH. And if they have, they don't even know who they're paying because it automatically is debited out of their account. If that's the case, then you can go back to your lender and say, who do I contact? And you would go back to your lender to get more information. So thank you, Laurie, for sharing that. Okay, so just to kind of recap, What exactly is forbearance? Well, basically it's putting your loan on pause. It's for a certain amount of period of time. It doesn't erase what you owe. It just means that you get to take a quick pause. And your missed or reduced payments, if you're paying a portion of if your client is paying a portion of their mortgage, then they will still have to pay the missed or reduced payments in the future. So it doesn't erase anything. It means you still have to pay. So under the CARES Act, which is the federal legislation that was enacted in response to the coronavirus, it allows borrowers to go in to temporarily suspend their payments if they're having financial difficulty due to the impact of the coronavirus. So again, here are the different kinds of loans that this applies to, the government-backed loans. So generally speaking, mortgage loans are government-backed or private loans. So the government-backed loans are anything through HUD. And for those in Indian country, we say HUD, but the mainstream industry says FHA, because that's where FHA is the subdivision of HUD that insures most affordable mortgages. But we say HUD because that includes 184, which is the what is used in Indian country under ONAP. USDA and VA, of course, with 502 and the Native American Direct Loan Program, and the VA guarantee and the 502 guarantee, which we don't see as frequently in Indian country. And then Fannie and Freddie also are government-backed mortgages, because Fannie and Freddie are entities that are regulated, that are part of the government. So those are the loans that are subject to the CARES Act provisions. CDFI loans are private loans, but their CDFIs have more flexibility. They can set their own terms and makes, have work through with their borrowers with more flexibility. If they're portfolio loans, if they're loans that they've made and they haven't sold to another entity, which is the case in South Dakota for now. So this is what CARES Act provides. So what does that mean? So what that means for your borrowers is that your borrowers have the right to request forbearance for up to 180 days. And what's happening now, you have to make that request. You have to call your service agency. What happens if you don't call? Then you're delinquent, because your borrower doesn't know that you're requesting, you have something that's impacted your finances from COVID-19. So you have to make that call. Your clients need to make that call to request the initial forbearance. What if you request 180 days and you want less time? That's okay. You can start paying again. You could call them and say, okay, I'm fine. I'm going to start paying again. But if you're not okay, then you have a right to request an extension for another 180 days. But as I said, you have to contact your loan servicer to request that forbearance. And you won't have new fees or new interest or anything as a result of the forbearance, but your regular interest is still going to accrue. So it's not going to change what you owe or the way your interest accrues. So that's the same no matter what. Now, here's the tricky part. What happens after forbearance? And this is where you want to make sure your clients know what to do. You heard in the video, they gave some great advice about questions to ask when you call your loan servicer. So you really want to look at what their options are. And as I said before, it's going to vary by the type of loan that you have. The government loans are much more flexible. The USDA and VA are much more flexible. CDFIs are much more flexible. But your repayment plan is what you work out with your servicer to get caught up on past due payments. So you have the option to pay everything that you missed, all the payments, in one huge lump sum. I don't know very many people in America that can do that. And that we don't want your borrowers to get into that situation where they've not paid their loan for 3 months, and that in month 4 they have to pay their month 4 payment and their 1 through 3 payments in one huge lump sum. That's a recipe for disaster for many of your clients, I'm sure. But a repayment plan could look like where in month 4 you're paying a little bit of extra to make up for the missed payments, and then you have another kind of repayment plan. Or your repayment plan might be that you pay those amounts at the end of the mortgage. And that could be also a loan modification. So the second area is a loan modification, where they actually change the original terms of your mortgage, where they make the loan longer so you can tack on the payments at the end, where they reduce the interest rate. They work with you to reduce principal and help get you back on your feet. And again, the flexibility there will depend on the lender, and that's something that your clients will need to negotiate. So the more you learn about the different options that are out there, the more you can do to coach your clients before they start calling their loan servicers. So as I know we're running out of, I'm just watching the time, but I want to quickly pause here to see if anyone wants to, especially our lenders on the line, if they want to share anything about these options. Okay, I'm going to keep moving forward, but please feel to interject as you like. And I also want to underscore our key takeaways here is that we know that the coronavirus is affecting each of your communities in different ways. Each of the communities in South Dakota, whether it's downtown Rapid City or in the heart of the Cheyenne River Reservation. Every community is affected in a different way, but it's pretty universal that everyone is having economic impacts. And so, but even those economic impacts look different for each individual family. So the bottom line to tell your clients is, if you can pay your mortgage, pay your mortgage. You don't want to end up getting caught up into a situation where you end up worse off than when you started. And as our friend in the video said, the mortgage servicers are experiencing very high call volume now. So if you don't need to have any mortgage relief, you don't have any financial impact, or you do have some financial impact, but you can still figure out how to pay your mortgage, the best option is to coach your clients about figuring out how to continue to pay. But if you can't pay your mortgage, or you can only pay a portion, definitely call your mortgage servicer immediately. Stay on, work with your clients to coach them, to explain to them the process, and have them stay on the line and give notice that there's an issue and that they have been impacted, so that they can shift into a forbearance state rather than delinquency, as we talked about earlier. Okay, so here's some examples of some of the resources. The CFE, when you get this, when we email this out, when the recording becomes available, you'll be able to click on the slide deck, and I think probably Heidi will post this on our website as well. But the CFPB page is we found to be really, really helpful and very useful in terms of coaching, like getting yourself up to speed so that you can share information with your clients. They have handouts, they have videos, they have all kinds of information. Specifically for coronavirus and for mortgage forbearance in general. So definitely poke around that page. The Urban Institute had some videos that I found really helpful that give you more, if you really want to get into more detail. These are links to 3 different videos about mortgage servicing. They're each about 3 or 4 minutes long. They're not long, but it provides a great overview of how the mortgage system works if you want that level of detail. The last thing that's on the screen is a USDA, for their 502 Direct, they have a new homeownership information guide. And that guide, I think, it's specific to 502, but it was really helpful kind of outlining the process. And because we have so many 502 borrowers in the state of South Dakota, it might be useful, especially if you have a 502 Direct borrower that you're working with, but also generally to get more information about all the different options for loan servicing, that loan servicers may have to provide mortgage relief. So those are 3 general resources. We're going to add the blog post that Mark talked about earlier from South Dakota Housing Development Authority, because as the Housing Finance Agency in the state of South Dakota, I mean, they, Mark and Brent and his team have really a great handle on the mortgage market generally in the state of South Dakota, and I know that they've got great advice and could be a great resource moving forward with this work. So before we talk about what's on the horizon, let me pause once more and ask if others have questions, comments, any information you want to share. Anybody like have other resources that you've run across that you think are very helpful that you want to share with the group? I mean, as Vicki said, even though you may have only had 1 or 2 people call you today and you only anticipate maybe about 1/4 of your clients having issues, it's definitely better to be prepared and to be proactive in reaching out to your clients and seeing if folks need help.
Hi, Joanna.
Hey, Colleen.
I just wanted to comment that we did a COVID-19 response for our clients. The board put one together, and we did have one client that can make like part of her payment, and then we call it a workout though. We're not doing forbearance or anything like that. It's a workout plan for our clients. And if it's if they have to totally be or if their income totally stops, then you know we step in and do a big workout plan with them. And sometimes that is writing off interest. It depends on, you know, what we can do to help them.
Fantastic.
I thought I'd just share that.
No, that's great to know. And I know that I think that we have somewhere, I was just looking at the mortgages that members of the coalition have helped to support over the past 4 years, and many of those mortgages have come through Mazaska. So many of the folks on the line, Mazaska might be their borrower. So it's good to know. Thank you, Colleen, for sharing that you guys are doing those workouts and being proactive about, helping your clients, your borrowers.
Yep.
So, and I know that if anyone from Cheyenne River wants to get on, I know that Forbearance is doing similar work as well. Thanks, Colleen, for sharing that. Okay, so as others think of other comments or questions they may have, let me turn it over to Leslie, who's going to share a little bit about what's on the horizon for the coalition.
Thanks, Joanna. So I think building on what Vicki and Joanna have said about the coalition responding to the needs of our members. So we hear we're hearing what the issues are. And as Colleen said, there are folks that may have difficulty making payments, both on mortgages, and also we're looking at our native CDFIs in terms of their business loans, because again, those entrepreneurs are part of the economy of our communities, and when they're impacted, maybe they can't make their mortgage payment, or again, they're part of the bigger picture. So we're developing this plan that includes today's webinar that is educational support for our members. So again, how to help your folks know what to say if they're calling their loan servicer, because it is really easy to say, well, call your loan servicer. Well, again, maybe there's a question of what to really say when you're on that call, when you can get through to the loan servicer. So that's why we're doing today's webinar. So we're thinking of educational pieces. We're also looking at navigating. There's so many webinars and so many emails and so much information. It's almost how to navigate through it and what's really helpful. So that's why we have the resources. That's why we have the website, just helping to prioritize almost. And then the third piece of what we're doing, so the navigation, the education, and also trying to raise some emergency funds, honestly, because there might be some loan funds out there that can help our borrowers, or your borrowers, but sometimes, again, we're getting the sense that additional debt isn't what people need at this point. They need some grant assistance to help them make that one payment, or maybe, again, like Colleen you were saying some of your folks can make their payments, but maybe they can't pay for utilities, or maybe they can't pay other related costs. And again, with the business lenders or the business borrowers, maybe again, they're also working on their business loans, but again, are there operating expenses that those businesses need to pay just to continue operating and get through this? So we are raising funds right now for this emergency loan fund to be able, actually grant, it's emergency fund, to be able to provide grants through our native CDFI partners to support their borrowers looking at mortgages and also business and entrepreneur borrowers. And again, looking at the mortgages, we know that there are other mortgages out there beyond the ones that the native CDFIs are making. So again, if someone might be having difficulty with their 502 or their 184 or their VA loan, that they would be able to access, again, this emergency support through the CDFIs. So we just wanted to share that. We'll definitely share more as it evolves and we develop it. But right now we're at the fund, we're trying to get that funding to provide these funds for, it's really looking at the borrowers, the homeowners out there and the business loan borrowers, but also looking to support our native CDFIs. So your portfolios are still strong after this. So that's what we're planning.
Thank you, Leslie. So we are at time. Before you all leave, though, we'd love for you all to give us suggestions for future topics that you would like to better understand. Maybe you all have, some of you on the phone or on this platform have something to offer that we could tap into you to present going forward. And also just to express other needs that you may have to help us think about, we'll do the research, we'll find out what we can. So feel free to email us and let us know. And if you have any comments now, you can put that in the chat box, or you can just follow up with an email. That would be wonderful. Our next webinar check-in is going to be Friday, May 15th at 10 o'clock Mountain and 11 Central. So just keep that in mind and we'll be preparing for that. But in the meantime, if you have any other resources that you think would be helpful, send that our way. We'll follow up with the PowerPoint and new resources that were identified in this webinar. And I think that's it. So we want to honor your time. Thank you so much for joining us. And we just ask that you have a wonderful rest of the week. Thank you.
Thanks, everyone. And we'll stop the recording now and end the webinar, but please feel free to go ahead and add anything to the chat box in terms of new topics or